The question no one can answer. Stop right now and look at the money in your pocket. I am about to expose a truth so fundamental, so audacious, it is actively eroding the value of your savings, your work, and your future every single day. You see endless headlines about global debt hitting impossible, astronomical figures, trillions piled upon trillions. If every country, every corporation, and every person is in debt, the single most critical question is, who is the ultimate creditor? The answer is not a nation or a billionaire, but a shadowy, powerful mechanism that has fundamentally broken the rules of money itself. This is not hyperbole. It is a financial sleight of hand at the very heart of our modern lives. Over the next 15 minutes, I am going to show you how the central bank conjures money from nothing using a simple accounting entry, how this process quietly makes you poorer, and the exact day our money lost its real value forever. Trust me, this is the history powerful global banks desperately want you to ignore. Origins. The alchemist's trick in fractional reserve. Our story doesn't start in a modern boardroom, but with medieval goldsmiths. Back then, real money was gold. People deposited their heavy coins with a trusted smith for safety, receiving a paper receipt in return the ancestor of your banknote. The critical moment, the original sin of modern finance, happened when the goldsmiths noticed a profound human pattern. Not everyone came to redeem their gold at the same time. This sparked an idea. Why let the gold sit idle? The first bankers began issuing new paper receipts loans for gold they didn't actually possess. They only kept a small fraction of deposits on reserve, coining the term fractional reserve system. Think about that. A new deposit was created from a loan, injecting money into the economy with no underlying increase in real value. The money supply expanded out of thin air. The rise of the central monopoly and the breaking point as this debt-based money trick spread, banking became chaotic, leading to constant bank runs and instability. Governments, realizing the incredible power involved, established central banks like the U.S. Federal Reserve in 1913, portrayed as the necessary lender of last resort. Their real power was the monopoly. They gained over issuing currency, cementing the fractional reserve system into law. For decades, there was one anchor, the gold standard. Central bank notes were, in theory, convertible into a fixed amount of gold, imposing a physical restraint on endless money creation. This all changed on August 15, 1971, facing mounting debt. U.S. President Richard Nixon unilaterally severed the final link between the dollar and gold. The Nixon shock officially ended the gold standard, ushering in the age of fiat money currency with no intrinsic value, relying solely on government decree and collective faith. The quiet coup, endless money creation, this was the quiet coup. The central bank was now utterly unbound. It could create money not just with a fraction of reserves, but literally with a few keystrokes on a computer. When the government needs cash, say, to service existing debt, issues treasury bonds, the central bank, using open market operations, simply buys those bonds, pays for them by digitally crediting the seller's account. That credit is newly created money injected directly into the system. It is born as a debt obligation, making endless money creation not a secret vault, but a simple, terrifying accounting entry. Fallout and modern parallels. The invisible tax, the inevitable fallout of this unlimited money supply, is inflation. This isn't just rising prices, it is the invisible tax levied on every saver and worker, systematically decreasing the value of every unit of currency you hold. A dollar from 1971 has lost over 85% of its purchasing power today. The central bank's own debt mechanism guarantees this erosion. Global debt has since exploded past $300 trillion. The system becomes dependent on this constant flow of cheap credit to service the interest on old debt. When the system faces collapse, the central bank intervenes by creating trillions more through quantitative easing. This saves the financial elite from immediate failure, but dramatically devalues the currency for everyone else. The harsh truth is, the system is not broken. It is working exactly as designed to perpetually transfer wealth from the creators and savers to the controllers and the indebted government. The path forward, the central bank, is the engine of the global financial system, maintaining stability while simultaneously promoting endless debt and currency devaluation. Understanding this mechanism is the only way to protect yourself. 3 key takeaways. Money is debt. Most currency is created through borrowing. The system requires perpetual debt growth just to survive. The anchor is gone. Your money is purely fiat. Its value relies entirely on fragile collective faith. Inflation is not an accident. It is the necessary, non-vote, upon consequence of an unbound, debt-based monetary system designed to perpetually devalue its own liability. The most dangerous assumption is that this will continue without serious upheaval. Every single unbacked currency in history has eventually failed. The question you must face is, what happens when the collective faith in the promise of endless money finally breaks? Will we return to a real asset standard, or will new decentralized money forms finally challenge the central banking monopoly? If you found this deep dive into the secrets of global finance eye-opening, then smash that like button, subscribe, and tell me in the comments. What is your primary strategy right now to safeguard your wealth from the invisible tax of endless money creation?